Rebecca, let me start with you because we continue to hear more warnings that the property sector clampdown could be going a little bit too far.
Yeah, we've seen more and more economists coming out. The first really was from Nomura, who warned that this could be China's Volcker moment. And Bank of America now also out with a research note saying that policy measures in the property sector may have gone too far, that they've been unnecessarily aggressive. And we are seeing the result in kind of among the stressed and defaulters of China at the moment. You know, property firms are once again driving this record wave of default, and we are seeing stress breaking out at lots of these kind of weaker rated property firms, not least of course at Evergrande.
And I feel like a broken record because I think we do this kind of pulse check every day, but are we seeing signs of contagion?
Well, I think there's sort of two parts to the question. So the first is particularly among these very sort of similar, weaker, financially riskier property firms. And among those, we have seen this cohort of kind of single B property firms that tend to move in tandem or in sympathy with Evergrande when we see those Evergrande bonds drop. But apart from that, outside of that, contagion actually looks relatively well contained so far. China high yield bonds, which of course dominated by property firms, returned to positive profits last month.
And Steve, of course, we also are talking about the education sector, and we have more scrutiny on tutoring firms as well.
Yeah, obviously we know that those have been decimated on the markets, and we're seeing more regulation coming down. Essentially, the authorities in Beijing are saying that these after-school and tutoring schools need to report to them on their status as nonprofits. Until then, they're not going to be able to sign up new students, and they're not going to be able to collect fees. That's in addition to earlier news saying that local governments will help set the fee schedule, because, look, this is also falling under this common prosperity theme, where a lot of parents have been, signing up their kid or kids to these schools to kind of get ahead in life. And it's created quite a market for exuberant marketing, if you will, and a lot of pressure on parents. If they don't sign up, their kids are going to be left behind. And so we've seen fees rising considerably. So they want to level the playing field, but they are also, some would say, going a bit excessive and killing off this industry, obviously.
Steve, we're also hearing some rhetoric from the People's Daily, and of course always influential what we hear from the state media sources, saying that China will boost transparency, protect investors. The editorial also says that this overhaul, this crackdown, is ultimately going to be, for the best of companies as well.
Yeah, I mean, there's a big debate going on in China, even among state media outlets, on what is the scope, depth, and breadth of the common prosperity theme, right? There was one article, a blogger actually put out an article praising it as a profound revolution, and some in even state media reposted that. It was subsequently taken down because it kind of got misconstrued or construed as an extension of Mao's cultural revolution. And again, the messaging has been mixed, and the markets have taken a hit, obviously. But there are ways to find, themes in the common prosperity. We've seen that Société Générale Common Prosperity Index, not surprisingly, beating the main benchmarks, and not surprisingly as well, that index of 30 stocks has no platform companies, it has no property companies, it's smart manufacturing, it's consumers, it's some financials. Is China uninvestable? Well, in certain areas, yeah, maybe there it is, but in other areas, you got to find the sweet spots.